Hello, everybody. Welcome to our webinar. We're just waiting to set it up so we're live on Facebook as well. Um, on the screen, you'll see three of us here. I'm Chandran Rajaratnam, President of Financial Freedom Wealth Management Group. We have DJ David Wright, who is our portfolio manager as well as a wealth advisor with Financial Freedom.
Hi, everybody.
And we have Sammy Gajardo, who is our marketing manager, and he's the one who does all the stuff behind the scenes to make DJ and I look good.
Hello. Yep, that's exactly right.
She takes care of all of our social media and all the webinars. She puts it all together. So thank you very much, Sammy. These monthly webinars are great, a lot of fun for us, and all the people that sign up, they really appreciate the information that we like to add. We just want people to be educated. So are we live, Sammy?
We're live. Let's kick it off.
All right. Well, today, welcome to our webinar. The main topic today is Social Security. Which I think for everybody, probably 50 and over, is an interesting topic because people that are under 62, you're gonna come up to it soon, and the people who are over, there may be some options that you hadn't thought of that if you're already on Social Security. We'll go through all of that, but we're going to start with a market update by DJ's going to give us that. Investment updates and what's happening, and then I'll talk about the Social Security after that. And please hold your questions. You can ask the questions if you like on your screen, and we'll answer them at the end if you don't mind, so we can get through the agenda, and we'll get back to all the questions and answer as many as we can on air. But if there are some that we need to do some research, we will get back to you with the right answer as well. Plus, we could talk to you by telephone and later on in order to make that happen. So first of all, so here's two other people. Oh no, that's us, DJ. Right.
Looking good, Chandran.
So portfolio manager and myself, but more importantly, who is Financial Freedom Wealth Management Group? So we were founded in 2000. Julia Carlson, our wealth manager and CEO and founder, started this business 21 years ago now, and built up our wonderful business serving, Dave Ramsey enthusiasts. Some of you might know Dave Ramsey. He's a syndicated talk show host. He has podcasts, etc. And he has produced, he's helped a lot of people. He's got some specific principles how people can get out of debt and retire comfortably using his 7-step program. So we're fans of the Dave Ramsey 7 steps, and we have several people who are enthusiasts that contact us for help. Retirees, business owners. We've also kind of spent a lot of time with women in transition. Typically we say women because many times it's the male that passes in a couple, and oftentimes the spouse, the person that passes, is the one that has been doing all the financial work, and therefore the spouse that's left behind needs a lot of help. And we're really happy to have had the opportunity to help a lot of people, widows, and in my case, I had a widower who needed that similar type of help. So that's kind of who we serve as a company. And so we're able to serve clients across the country. I have clients in 37 states, 7 wealth advisors, and 11 support staff, and all of us are one team. We do have 7 physical locations, Oregon, Washington, Massachusetts, and LPL Financial. I'll talk a little bit about that later, but LPL Financial is our broker dealer, where people that open accounts will be opening accounts at LPL Financial. So here's our team, good looking group of 18 people. More importantly, a solid team working together to help all of our clients and help the business. I guess one of the things that's kind of neat about us is, we're big enough to be able to do everything for our clients and small enough for us to know who you are if you are a client of ours as well. So you can become part of the family. Yeah. One of the key things that we think differentiates us, and it's not that we intended to differentiate ourselves, but the way we come together in order to serve our clients is we have a set of core values that we will never violate. And that's treat all people with respect, never compromise their integrity, delight our clients, and embrace our team culture. The fact that, individuals can make mistakes, but oftentimes you can have a team that doesn't. We can actually get to the point where the team can be perfect, even if the individual can't. And that's our goal, is to keep doing that. Our commitment is to care deeply for our clients and their financial life. And then to create a plan for our clients' dreams and inspire them to pursue financial freedom. So that's who we are. And if you are a client of ours already, I hope you see all of that showing up in our day-to-day action with you. And if you're not, we'd love to welcome you to that. So let me turn it over to our portfolio manager, David Wright. We know him as DJ. And DJ, take it away.
Yeah, thanks, Chandran. So this is my favorite thing to talk about. Now there's so many opinions out there, right? I'm sure all of you hear things all over the board, right? There's a bubble, there's no bubble. It's hard to know where we're actually headed ever. Bottom line is nobody knows what's going to happen, right? Nobody knows what's going to happen in the stock market tomorrow, next week, next month, next year. But here's what we do know. So we invest in a way where clients' accounts are set up for anything, right? We don't get surprised or caught off guard by recessions. It's inevitable. It's part of investing. Over the long term, though, markets do very, very well, and we invest for that. So we use well-diversified investments, capturing all areas of the market, comes out to be thousands of companies all over the world, all different types. And then we use the bucket strategy. So if you need income from your accounts, we're going to have about 3 to 5 years worth of your income needs in a conservative bucket that's not moving up and down like you hear on, like the rest of the market and you hear on the news. So with that said, there is a lot to be positive about. And now I'm going to give you kind of our opinions on the stock market. So again, we have a pretty positive outlook. So another term for this is bullish. The stock market's likely to go up in the near term. And there's 4 main points that I just wanted to review with you guys. So the first one is the amount of cash that's sitting on the sidelines. So, and these numbers were from a couple months ago, so there's even more now, but $35 trillion worldwide just sitting in checking accounts, savings accounts, money markets, doing nothing. 20 trillion in US dollars. So the US personal savings rate is extremely high, and the average household has saved more than 22,000 during this pandemic. So it's pretty incredible. This comes from mortgage rates going down, right? I know a lot of us have refinanced. I did that recently. So we're saving 10 billion a month on interest. You also have unemployment benefits, the stimulus payments, and a closed economy, right? There's nothing for us to do. So because this money's doing nothing, right? Because interest rates are so low, it's likely to go back to work somewhere. And that's this next point, right? Interest rates are very low. Actually, Tron, if you back up there one more moment, I'm still on this slide. Yeah, thank you. So interest rates have been cut due to monetary policy, right? This is a way to help kind of jumpstart the economy. So in 2008, the 10-year treasury note paid 4%. Today, that same note is paying 1.5%. So, very, very low. You're not being rewarded for lending money to the government. Now, this actually has increased recently. It was 1% a few weeks ago, and we saw a little spike. You guys may have seen it on the news, but it's still very low. So you're actually losing money due to inflation. And the bottom line is you just can't earn much interest in things like savings. There's no high yield savings accounts these days, CDs, money markets. So this encourages money to flow to the stock market. And it also means that companies can access cheaper loans and expand, which is another positive for the stock market. So my third point is that we are opening back up. I think we are all, a sigh of relief. We're all ready for it. It's been a tough year. Vaccines are being administered. We're starting to see parts of the country open up, and hopefully that's going to continue this year. And there's huge pent up demand, right? We're all ready to get out there and do things. I know I sure am. We have trips that we want to go do. We want to get out, go have meals together, go see people and spend money. So with record savings, low interest rates, it's likely that we're going to be spending in the economy and investing in stocks. So the economic expansion that's coming looks to be really, really big. And then my last point is stimulus. And this is perfect for today because it actually just passed this morning. So it's going to go to Biden's desk tomorrow, and he'll sign off on it. And that's another 1.9 trillion in total. More of the things that we've seen. So more cash for Americans, 1,400 looks like per person. There's going to be more unemployment benefits, tax rebates, helping small businesses. So, this definitely goes and helps people who have lost their jobs and are hurting. But a lot of it also goes to people who don't necessarily need it to survive, but we're going to go spend it. And that's going to help boost economic activity, another positive for the economy and the stock market. And then on this, I did want to touch on, inflation concerns, right? We're pumping so much money into the economy. There's a lot of concern with what's going to happen with inflation. It's got to be a problem. So there's a couple things I wanted to mention here. One, there's kind of these structural forces that are keeping inflation low. It's we have cell phones, right? We purchase most of our things from our cell phone. We've got the internet. We can shop around and we could look at 30 prices for the same good in a matter of minutes. So this really helps keep prices down, right? You're not forced to go accept a price, down the street. There's a lot of transparency out there. We know what a fair price is. The other piece is globalization, right? So we're a connected world. You don't have to just buy from your local area, right? We can buy from other countries. So all this really helps keep inflation low. Yes, we likely will see an increase, but historically speaking, we're in very low inflation environment and have not even hit the 2% target that the Fed has. So these are kind of all the reasons that we do feel pretty good about the stock market going forward. But again, we're always ready for anything.
Thank you, DJ.
Yeah, my pleasure.
Yeah. Now, one of the things about our clients' portfolios is that our own 401k is in that same portfolio as well. So we're in the same arena as our clients, and we're looking forward to what we think is going to be a positive year in 2021 at this point. All right, well, let's move on to a subject that's dear to many people's hearts, Social Security. Now, there's been rumors about Social Security and how it's being funded and whether it's going to last. Sometimes I tell my 20-year-old, kids, some clients we have in their 20s and 30s, I said, let's plan by the time you're 65 that you don't need Social Security to make it happen, just to kind of go along with all the rumors that, there's problems with funding. In reality, Social Security is just fine till I think another 12 or 14 years. And then with some minor changes in taxes, we'll be fine forever. So that's kind of good news. So I would encourage people not to listen to some of the other stuff. It's when you think about it, almost half the people in Congress are Social Security age. And I've never seen anybody in Congress actually do something that hurts themselves, especially with Social Security. But this is a subject that has a lot of interest, a lot of history. Let me read a little bit about the history of Social Security here. I've got some notes. It was signed into law on August 14, 1935. And then taxes were collected for the first time in January 1937. And the first one-time lump sum payments were made that same month. Now, regular ongoing monthly benefits started in 1940. So on January 31st, 1940, the first monthly retirement check was issued to Ida Mae Fuller of Ludlow, Vermont. And the check was a stupendous $22.54. And she collected monthly benefits until she passed away in 1975 at 100. And she collected a total of $22,888 in benefits. Right? Now, from these modest beginnings, Social Security has evolved from a retirement program for workers into a family-based economic security program. The Under the 1935 law, what we now think of as Social Security only paid retirement benefits to the primary worker, but in 1939, a change in the law added survivor benefits and benefits for the retiree spouse and children. In 1956, disability benefits were added, and then Medicare began in 1966. Right? So that's now Social Security is funded primarily by a tax you pay on wages, which is matched by your employer. So that's a little bit of background here. I'm glad Ida lived till 100 because that way she could get the maximum out of Social Security. So that's if there's nothing else, you got to stay healthy so you get the maximum Social Security amount. I want everybody out there to live till 100. Actually, I joke that if you're a client of Financial Freedom, we actually guarantee you live till 98. So, at that point, if you don't make it, come on back. We'll make the guarantee. So it's great. So maybe you can make it to 100 at that point. Now, many of you know what this looks like. They stopped sending out statements a while ago, and now it used to be every year, and now it's like every 5 years. But you may have received a Social Security statement, so signed into the website ssa.gov and created an account. Now, when you look at your statement, what you get is the full retirement age, what you're going to get at full retirement age. And that's known as your primary insurance amount, or PIA. Social Security loves its acronyms. Now, you may have looked at the table that lists all the years of earnings you had going back to your first job. But to me personally, the most important part is at the very beginning. It's the third paragraph, and don't worry if you missed it. What it says is that Social Security is not intended to be your only source of income in retirement. On average, it'll replace around 40% of your pre-retirement income. So obviously, you may want to consider having outside assets in order to supplement that to be comfortable in retirement. You may want to consider having a variety of retirement assets such as IRAs, annuities, pension plans, 401ks. All of these pieces of the puzzle of investment professionals to help you put together. So we can help you put this together and figure out how all of these things go together. So you have the type of retirement and comfort in retirement that you want. But we know Social Security is going to be a very important piece. And let's take a deeper look at it to see how that works. So first of all, let's look at how retirement benefits are calculated. The Social Security Administration, SSA, use something called your full retirement age, or FRA. See, those acronyms are showing up already, as the basis for calculating Social Security benefits. Now, it starts at age 66 for anyone born between 1943 and 1954. And gradually increases to 67 for those born in 1960 or later. Now, for anyone turning 62 this year, your full retirement age is 66 years and 10 months. Right? So just keep that in mind. You can take a look at this chart to find your full retirement age. Now, knowing your full retirement age makes it a lot easier to understand Social Security. And if you take any Social Security benefits before FRA, or full retirement age, they will be reduced. And if you apply for benefits after your full retirement age, they will be increased. So let's take a look at that. So now a couple of key things before we even look at this chart is that in order to be eligible for Social Security required benefits, you have to have worked for 40 quarters, right? Or 10 years if it's contiguous, but it could be in one quarter this year, 3 quarters another year, etc. Now, the definition of a quarter is it's a calendar quarter, but counts as long as you earned income of $1,470 in that quarter. So if any quarter you make $1,000, if you're a young person just having a casual job, that doesn't count. As soon as you get over 1,470, then that quarter counts towards your Social Security benefits. And so you need 40 of those to get any Social Security benefits at all. Right? Then they average your earnings over 35 highest years of work to determine your Social Security benefit. So if you work for 36 or 37 years, that 36th and 37th, if it's near the end, right, it's at the end, obviously, and you have higher income than the age when the first year, the second year, they knock off the first 2 years and then you get the higher 2 years at the other end. So 35 are the highest years. And so the longer you keep working, it knocks off those low earning years you might have had when you first started. Now, as you said before, if you claim Social Security before full retirement age, it's permanently reduced. So if you take a look at that the chart, a full retirement age of 66, and if you take it at 62, you'll get a 25% reduced amount. And if you wait till 70, you'll get a 32% increased amount. So it's 8% a year is what it's going up to that. And in these 4 years, it's 25% in those four. I guess it goes down by 6.7 a year for those 4 years. Now, if on that previous scale, if your full retirement age is 67, then you see the difference here. It's 30% lower if you take it at 62, and 20%, 24% higher if you wait till 70. Now, SSA, Social Security calls this 8% credit at the higher end the delayed retirement credit. Right? However, saying delayed subconsciously encourages people to take Social Security as soon as possible. So that's we talk about Social Security benefits growing. All right, so that's kind of the base Social Security, and your financial advisor, and if you'd like to come to us, we'd be happy to help you try to figure out in your own particular situation when you should take it. There are lots of factors that come into play here. If you quit working at 62, then you may want to take Social Security early, especially if that means that you'll take less out of other retirement accounts that are growing in the stock market. On the other hand, if you're married, you may want to maximize at least one Social Security so that the survivor's benefit, should one person pass, is then higher. So there's a lot of things that we can't put it all the options in a webinar, but come talk to us and we'll help you figure out individually how that works. I mentioned spousal benefits and how to maximize it. So let's look at a case study. If you have Jack, here we have Jack and Diane, right? Jack is the higher earner. Diane's retirement benefits are less than spousal benefits, and Jack's annual Social Security retirement benefits are at 62, 7,500, 66, 10,000, and 70, 13,200. Now, spousal benefits start at 50% of the primary spouse, right? So if $10,000 was chosen, we only chose that because the math is easy. It's not representative of a typical Social Security benefit. So let's take a look. What is Diane's maximum and minimum spousal benefit? If Jack claims retirement at full retirement age at 66, and Diane claims spousal at age 66, what do you think she'll get? Okay. I know everybody's just shouting out into your television. I can't hear you. So, but, all right. So the answer is $5,000, right? So that's 50% of the $10,000 that Jack gets. Now let's assume Diane applies at 62. What is the maximum spousal benefit? Right? If you said 3,750 or a 25% reduction from the 5,000, you would be correct. Remember the percentage on that scale if you take it early. So same thing happens to spousal benefits. If you take spousal benefits early, it reduces by that 6.7% per year to 25% lower. Right. All right, so that's pretty straightforward. So depending on how old the spouse is, that takes the spousal benefit, determines how much she will get. Now, Jack claims at age 70. What do you think the spousal benefit is for Diane? Right? The answer is the same. See, Diane will receive 50% of Jack's age 66 benefit no matter when Jack claims. If she claims at 62, she will earn the lower amount of 3750, regardless of when Jack claims. So the spousal benefit is always based on the other spouse's benefit at full retirement age, regardless of when the spouse claims Social Security. So final example is Jack claims it early at 62, and similarly, there is no change to Diane's. Hers is the same, is based on Jack's full retirement benefit. Now, the other thing that's also available is something called a survivor's benefit. After the highest earner passes away, Social Security can provide benefits to the surviving spouse. The surviving spouse could receive up to 100% of the deceased benefit if the surviving spouse is of full retirement age or older when he or she claims the survivor's benefit. Even if the surviving spouse is receiving a reduced retirement, you can still receive 100% of the deceased benefit. So if one person has got a reduced retirement and the spouse passes away and he's got the higher amount, he or she can step up to the other person's. And by the way, the surviving spouse is eligible for a reduced survivor's benefit as early as age 60. Does that to wait till 62, and 50 if the surviving spouse is disabled. Right. The maximum benefit, though, at age 60 is 71% of the deceased benefit. So the amount the survivor receives depends on when the highest earner claims his or her retirement benefit. The higher the deceased retirement benefit, the higher the survivor's benefit. So if the deceased had waited till 70 and got the higher Social Security number, then the survivor would also get that higher Social Security number as well. So there's another thing to take a look at, not just your own Social Security, but what would it mean for your spouse should you pass first. Again, individually, we need to figure that out for you. Now, so how does a deceased claiming decision impact the survivor's benefit? Easy to illustrate by looking at a hypothetical. In 2021, the average bailed would receive $26,000 in annual security retirement benefits if he claimed it at the full retirement age. The difference in the survivor's benefit, if he took it at 62 versus 70, is over $12,000. Could an extra $12,000 a year make a difference for some of you? It probably could. So for the spouse with the higher Social Security benefit, I encourage you to change the conversation from me to we. It's because the benefit of the spouse with the highest Social Security benefit becomes a survivor's benefit. So something to consider on that. Earnings limit applies to any benefit received after full survivor's age. Remember, the earnings limit applies to any benefit, but there are options. You can start with the reduced survivor's benefit, switch to retirement, or start with the reduced retirement and switch to survivors, whichever is higher. Now, if you're divorced but your marriage lasted 10 years or longer, you may qualify for benefits off your ex-spouse. You can receive a spousal benefit off your ex-spouse's record, even if he or she is married, as long as you're unmarried and you and your former spouse are age 62 or older, and your ex-spouse is entitled to Social Security, retirement, or disability benefits. Unlike married couples where your spouse needs to apply in order for you to receive a spousal benefit, if you're divorced, your former spouse does not need to apply for their retirement benefits in order for you to receive a divorced spousal benefit. Now, you don't even have to contact him or her. If you can provide the Social Security office with your former spouse's name and Social Security number, so always keep that, a copy of the marriage license and divorce decree, the Social Security Administration will check to see if you qualify for a benefit. Now, if both divorced spouses worked, each spouse generally received the greater of their retirement or spousal benefit. So, by the way, if you're born before 1954, there's something called a restricted application, and we could talk about that as a special case now because they took some of those rules away a while ago. where you may have more ways to start with a spousal and go later on to your retirement benefit. Not as many people are qualified for that, but if you're born before January 1st, 1954, and you fall into that category, give us a call and we'll help you figure that one out. Right. Now, if your former spouse has passed away, you're entitled to a survivor's benefit as long as you're age 60, unmarried or remarried after age 60. Right. If you're working and under the full retirement age, the earnings limit applies to your divorced spouse. Remember that, down to that 71.5%. That also applies. As a general rule, if you remarry, you forfeit the benefits off your former spouse, but there are two exceptions. If you remarry after age 60, you can hold on to the survivor's benefit off your former spouse, even though you're remarried to your current spouse. Looks like Social Security has a whole bunch of rules on this. They really like divorce and death and remarriage and, hey, let's just stick together for the rest of our lives and, not wake up one morning. That's what my wife and I talk about. So, but anyway, a lot of people fall into this category about divorce and remarry. One little quirk on this, I was listening to a presentation once on Social Security, and technically, if a person marries and divorces a spouse after 10 years 4 times, all 4 of those ex-spouses can get Social Security off that person's record. So it's not that I recommend you marry and remarry 10 times after 10 years and do it 4 or 5 times in your life. But one thing to remember is that if you're 58 and thinking of getting remarried, if your soon-to-be new husband make less than your first husband, you may want to wait until age 60 to remarry so you can retain the survivor's benefit. Right? That's a tough conversation to have, dear. I love you. I'd love to marry you, but I want to wait 2 more years because I want to get higher Social Security. But hey, if it works for you, good. But it's again one of the rules inside Social Security. All right, I know that might cause a bunch of questions, and happy to do that. If the former spouse remarries, it does not affect your benefits, right? So it's now if both marriages ended after 10 years, the remarriage case, Jane was married to Tom and Theo. Both marriages lasted at least 10 years. Both ended in divorce. Jane receives a higher of her retirement benefit, the survivor benefit from Tom, right, or the spousal benefit from Theo. So lots of choices depending on what that situation is. And I would kind of recommend this is kind of give you a flavor for all the different complexities inside Social Security. And therefore, don't memorize any of this. Just give us a call and we'll help you out. Figure that out. And here's that one I was telling you about, the restricted application. If you're born on or before January 1st, 1954, and you're at least 66 or older, and your spouse has applied for retirement, you can take spousal and let yours grow till 70, and then take that later on. You can't do that anymore, but it's an interesting called grandfathered in. It used to be the rule of the land at that point, and now it's got changed. But they still grandfathered people born before 54 into that thing. Now, one of the favorite topics of all of this is taxes. Actually, we don't like taxes at all, but Social Security decided to make that even a little more complex. But trying to simplify it, regardless of your age, once you start taking Social Security, your benefits may be taxable. If your income exceeds $25,000 if you're single, or $32,000 if you're married filing jointly, right? So no tax up to that point. As soon as you reach that point, it's tax. Between 25 and 34,000, as you see here, single, and 32 and 44 married filing jointly, half of your Social Security benefits are taxable. And then if you make more than those amounts, 85% of your Social Security benefits are taxable. I know I have several clients talk to me, wait a minute, it was a tax that we paid and now we get it, and now we have to pay tax on the money we get because of the taxes we paid. Okay, the logic goes round and round, which is who knows, but that's the way it is. So, our poor government, they need the money. All right, just come on, let's not complain. So, but to determine how much of your Social Security benefits could be added to your income and thus become taxable, the IRS uses something called combined income. It's formerly called provisional income. Excuse me. Combined income is your adjusted gross income, AGI, plus your tax exempt income, things like municipal bonds that are tax exempt. You got to add that back in, right? Which again, back to that. Wait a minute, if it's tax exempt, why do I have to add that back in? You do. Plus half of your Social Security benefits to come up with the income that is taxable for you, right? So that's how they work. By the way, Social Security income is not included in AGI at this point, adjusted gross, obviously, because they're adding it later. So that's how you figure out if it's taxable or not. So it's now one more thing to be aware of: some items are not included, right? So Roth IRA distributions, qualified charitable distributions. So this is kind of the good news side of this, the taxable issue. Non-taxable portion of pensions and annuities, any inheritance and gifts, life insurance proceeds, and then health savings account withdrawals, right? So at some point, it may be advantageous when you have IRAs to try to get it to be Roth IRAs before you retire, so that any distribution you get from that is not added to your income to figure out if you pay taxes on your Social Security. One warning though, if you convert an IRA to a Roth IRA while you're still working, know that that's a taxable event, and because the taxable event, and then Medicare tax and all those other things have to be paid on that, which may mean that you don't want to convert it. So again, individual situation, you need to come talk to us, right? But a couple of things to think about. So when you come talk to your financial advisor, and we'd love to be your financial advisor if you're not one of our clients already, we need to know how long you're going to work, what's your withdrawal rate, right? How much do you need to live on, what's your life expectancy. I joke with my clients, we can figure it out to the penny if you just tell me when you're going to pass, exactly the day that everything else is just fine. But nobody knows, so let's just assume you live till 95 or 98 and figure out how to make sure your money lasts until then you have comfort in your retirement. Right? So whether you're single or married, and all those things are the different factors that go into play. Right? Now I've gone through a lot of complex issues with Social Security, but these are the things. It's just to whet your appetite. If you have questions, to contact us. You can ask questions on this webinar if you like, if it's more general, but if it's more specific, it's best we find out more about your situation, and then we can help you. We can do it by telephone if you have just a quick question. Call any of our wealth advisors, call our office and wealth advisors, or better yet, get to a complimentary consultation we'll offer for people on this webinar. So that's a quick rundown of Social Security. For the next steps, in our case, is that we come talk to us. We'd be happy to help you. Financial freedom. Our process is we simplify the financial world by leading with education. Things like these webinars, we think if people can be better educated, they can make better decisions about their own lives. Working with a financial advisor so that they have the best outcome they can have for themselves and their families and their dependents, as well as the people that they want to leave the money to. Then our process starts with an education encounter. Then we go through this thing called a fun-filled discovery process that understands everything about your goals and needs. Then we provide a tailored solution to individual needs. And then our goal is to guide you through the rest of your life. Our services that we provide are a broad range. As we say, as I said before, we're big enough to be able to do everything for you, and small enough to know who you are. Investment management, retirement income distribution, tax planning. Do a lot of education events, consulting services, and also if you have a small business, we have a whole program talking about how to maximize your exit strategy, uh, tax havens that are there for small business owners, etc. All right, so we look forward to hearing from you. If you're new to financial freedom, text freedom to 458 777 4458, and you can schedule your financial review today. DJ, what do you think?
That was good stuff, Chandran.
Are you ready to retire? Take a Social Security then?
Yeah, I'm ready. Let's plan it out.
Okay, all right, good. All right, another 30 years, give us a call. Right, so you could, now 30 years from now, I'll probably be in the Caribbean on a beach. I'll still be on Zoom, so you can talk to me then, but, it might take, yeah, might be a tough conversation 30 years from now.
And then Chandran, we have that really important slide. Yeah, there we go. Well, this one's great.
So yeah, the LPL Financial is our broker dealer. Broker dealer meaning the accounts we open, they're the custodian of the funds, etc. They were formed by a merger of two companies called Linsco and Private Ledger back in the late 60s, early 70s. They are the largest independent broker dealer in the country. They have over 20,000 advisors. What we like about them is that they have no proprietary products. So there is no conflict of interest. We are totally independent. All 7 of our wealth advisors are full fiduciaries, and everything in the market's available to us so that we can package together what's right for individual customers for their needs. They belong to SIPC, which is a membership that is an account protection of $500,000 per person. That means if LPL goes under, SIPC will cover your account for $500,000. Plus, they have $575 million of private insurance. But since they don't have any proprietary products like a mutual fund or something to fail, I guess all of the 20,000 advisors would have to leave them before they had difficulty. And all of our securities registrations are held with LPL Financial. Now, of course, the protection is against any sort of thing that happens to LPL, not about market. The markets go up and down. That's when you and we work together in order to make sure that maximizes your portfolio. And then the next step for all of you is I'd like everybody to read out loud these disclosures. I think it's in a different language, but these it's important disclosures that tell you the small print. And if you want a copy of that, give us a call. We'll send you a copy. But that's about LPL Financial and the SIPC that I was mentioning.
And then we did have a couple of questions, Chandran. I know there was one, just the difference between an IRA and a 401k. So I can explain that. Really, a 401k is tied to your employer, right? An IRA is on your own. Now, generally one of your options, sometimes you can move money between the two and it could have the same tax treatment. It's just, again, 401k is tied to an employer. IRA is going to be, it's not connected to any employer. It's all on your own.
Thank you, DJ. Actually, there's 2 other questions that I can answer. Mm-hmm. If you're retired at 62 or thinking about stopping work and taking Social Security, you can take Social Security early as long as you don't make, and then go back to work part-time or whatever, as long as you don't make $18,960, more than $18,960, everything's fine. If you make more than $18,960 and you take Social Security at 62, between 62 and your full retirement age, they will take back $1 for every $2 over $18,960 that you earn. So So generally, we advise people if you are going to make earning money that's more than the $20,000, 18,960, then better not to take Social Security early, and we can advise you on that. Just a little quirk: on the year you turn full retirement age, you're allowed to make 50,520. Don't ask me why Social Security makes that complex, but let's say your birthday is in July and your full retirement age is 66 and 2 months, and September is your full retirement time. You can make up to 50,520 between January and September without worrying about it. Otherwise, for every $3 you go over, they'll take back $1. So if you talk to your financial advisor or talk to us about your particular situation. The other question I had is when do you actually get paid your Social Security payments? Let's assume in August is your 66 and 2 months, if that's your age. Technically, your Social Security starts September 1st, and you will get paid in October, 1 month in arrears. And the date of the month, the time of month you get paid will depend on your age. I've got the scale somewhere, whether it's by the 10th, the 20th, or etc. Any other questions, DJ?
Yeah, another one just came in about a 403B. So a 403B is very similar, excuse me, to a 401k. So again, it's tied to an employer, but they're generally going to be more public employees, nonprofits, things like that. But it really acts in the same manner as, say, a 401k.
Okay. All right. Well, if you have any more questions, please contact us. You saw that previous slide where, again, you text to. So I can go back to it.
And I think we had a couple more come in, Chandran, as well here.
Okay. I can't see it on my screen, so if you can
Okay.
read it.
What if a spouse died before being old enough to claim Social Security?
It would still apply because it's not about whether they were old enough to claim it. As long as they have Social Security record and a benefit, then the spouse is eligible for it. Again, all they need is their Social Security number of the spouse, call the Social Security Administration, as well as the death certificate, etc.
And then we got if my spouse is older, thus eligible for retirement benefits much earlier, but my earnings history is much higher, is it better for my spouse claim the spousal benefit rather than his own retirement benefit? Does he have to stick with this choice for life, or can he start taking the benefits?
So he can take his own benefits at the time that he turns full retirement age, and then when you turn full retirement age and you got the higher number, he can switch to the higher number after you apply for your own. What he can't do is just take the spousal first and then let his grow. That's the part that went away. So the way it works is they automatically give you the higher of the two. Actually, they give you your own plus the extra to make up the higher of the two. Any other questions?
Looks like one last one here. So in common law marriage states like Pennsylvania, that you can collect spousal benefits if you were together for at least 10 years. Do we know anything about that? No longer together, never remarried, had some kids.
I cannot answer that question. Don't know that, but I'd be happy to research that for you if you want to give us a call. Because I would suspect it's similar to if it's just the fact that the common law is legal for in that state, it would be similar, but I would want to double check that before I give you a specific answer in that. Which is great. I got something I can research. And that's Pennsylvania. We'll start with Pennsylvania first and then see if that's a national, whatever I come up with is national. Text us, whoever asked that question. I'll help you find that out. All right. Okay. Well, thank you very much for attending our webinar. We have one a month. If you're on our email list, you'll get that. There were some wonderful ones done in the last few months as well. December, we did one on love letter. DJ, you did one recently. What was that on?
I do the market updates a lot, but it's usually going to be me. We did the tax planning one,
Tax planning, market
general
update.
retirement. Yeah, all different things.
Later on this year, we'll do another one on Medicare, close to the Medicare open enrollment period. So
yeah, really, we want to have topics that are going to be helpful for people in different stages of retirement planning. Some getting started, some getting close in retirement. So
yeah. Well, good. Thanks again. This will be on our website, this webinar. So if you wanted to refer to it again, it will show up in a couple of days. Take a look. It'll be on our website. Okay. All right. Take care. Goodbye, everybody. Thanks for attending.